Hey, good afternoon, everyone. Marty Missouri here, September 30th, Friday, 2022, with your end of week market snapshot. I'll circle back either later this evening or tomorrow with your weekly economic update. So, really volatile week again to end the quarter. Incredibly volatile day today. We'll look at the charts, and I want to read from this morning's note from the folks who we subscribe to their information, their data, their daily notes. They are experts in the underlying positioning among options dealers and hedgers and so forth, and they give us some insight as to the degree of which that is impacting the day-to-day market volatility. Very interesting day today with regard to that. So let's just jump in there with the hourly chart, which, as I keep telling you, and is still there, folks, believe it or not, pretty bullish look. We remember we had this falling wedge that I said was really looking good because we had these divergences right here along with that. And I said we break out of that and that's going to be a pretty strong buy signal. And we had a really huge day, best day in a couple of years, right? And honestly, I thought we were going to probably see some momentum build there. The next day, we actually got some pretty good economic data, and then Fed speakers who just hammered this market right back down to earth the next day. Okay, so then been fighting with this. Each candle is an hour, or pushing against this support line right here, and broke through that and set a new low for the year at 35.85. But what do we have? We just have an extension of this falling wedge pattern now, and we still have positive divergences here. So we still have what looks like a pretty bullish setup awaiting another breakout to the upside as a buy signal for short-term traders. So yeah, nothing on the hourly chart just yet that says we're not going to get a pretty nice upside pop. And I'd still say it's a bear market rally, right? And again, as we've been preaching, or as I've been preaching in here too, some of these very compelling patterns, both upside and downside, which have worked just beautifully for the most part for several months. At this leg, if we're right about where we are in terms of the bear market, that's where these bullish short-term indicators can fail, right? And you're seeing that happen now more often than we've seen all year. And what's playing out? The bearish indicators, right? The bear flag playing out to a T and so forth. Same thing on the one-year daily chart. The bear flag here, right? Price target, boom, went right down to it, played around with that for a while, broken down through this level right here. But what do we have, right? Pull that in. You can actually pull this down. Pretty seriously oversold, right? And I showed you this before. We have that, so we're pretty much still in that positioning right here. This is real basic stuff, but you get that here, and you tend to get some tradable short-term rallies right out of that. Yeah, pretty consistently. If you went back here a little bit, you'd see one, and we had a really strong rally into the peak up in here. So that would support the notion that market's oversold, therefore a bounce is due. So let me skip to the monthly, and then I'll talk at you and tell you what I'm thinking. Now we'll just run a really tight 5-year monthly chart. So folks, multiple times over the last year or so, I guess, I've shown you our monthly MACD sell signal, and that we really don't have any false signals, and that when we're outside of recession, even though we're in recession here, but typically when we're outside of recession, you want to buy when the market hits the 50-month moving average, and that's right at 3,500, actually 3,523 now. We'll still say 3,500 is our target, but that is typically when you're outside of recessions. If you go back to the 2008 and the tech bubble recessions, the market crashed right through that to the tune of 50% decline in the tech bubble scenario and 57% for the S&P in the, call it the real estate and mortgage securities bubble in 2008. So we are definitely flirting with recession if we're not already in there. Our assessment is that if we're not there, we will see a recession relatively soon, but our assessment also is that it will be a mild one. Ironically, the Atlanta GDP nowcast has actually the economy growing at 2.5% for the current quarter, which just ended. So it looks like we're going to see a positive GDP print, and that's going to question whether or not we're in recession. I can tell you the stock market would actually probably like it better if we were, because it would view that it would be inspiration for the Fed to back off of the tightening. There's nothing about what they're saying that is suggesting they're willing to do that anytime soon. Now, the problem with being so close to our price target right here is that we've been maintaining that the first leg of this is more about interest rates going up and therefore the valuations of stocks being too high, and they call it multiple contraction, as is price to earnings multiple contracting to more reasonable levels. And then the next leg, we were saying and continue to say, is going to be earnings disappointments going forward. Analysts have been too sanguine over the prospects for earnings. Now, we are seeing earnings come down in terms of the consensus estimates. I suspect, and I'll know here shortly, in fact, I'm certain anyway, that we're going to come into the earnings season with a scenario of net negative revisions among the analysts. Now, typically, when you come into earnings season where revisions have been on balance lowered, believe it or not, stocks tend to do very well, and vice versa. And I've talked about that already. When they come in higher, they tend to be lower during earnings season. So that setup is there. It's also the seasonality of the fourth quarter. I learned today from Ned Davis Research that since 1946, nearly 70% of the time, the fourth quarter is up by an average of 5.5% when we come into the quarter down on the year, right? When we come into the quarter up on the year, about an 83% chance that we're going to come in, that we're going to continue to go up for the fourth quarter, but to the tune of 4.5% for the fourth quarter. So seasonality, and you never want to trade just on seasonality, but it's interesting to look at, says that it's going to be a good quarter, and it's going to be a nice, upward move. 5.5% in any quarter is a good move. We'll see how that plays out. A lot of that remains to be seen. Lots of negativity out there. And so, folks, you've heard me suggest this, and if you're reading the blog, I've been writing this as well. In fact, today, this was kind of the main topic on the morning note, is that I just can't seem to find many, if any, bulls out there. The macro analysts who I respect the most, they're all pretty much very, very bearish, and legitimately so, and they're citing the kinds of things that we've been citing to you for a long, long time now. I'll tell you this, that darkest before the dawn saying or metaphor really applies to markets. It's been my experience, and it's been my study of history. Typically, when you can't find anybody who has anything good to say about the market, that's about the time you want to be buying the market. So we want to be very, very open to the idea that we may indeed, as our price target suggests, be very, very close to the end of this. And I don't think it's just going to be we tap that and then we're off to the races. I think it's going to be a somewhat drawn out, very bumpy road, testing lows and so on before we begin to build something sustainable to the upside. I am starting to think that maybe earnings are going to surprise better than what analysts are ratcheting them down to. So we're kind of flipping a little bit in our narrative there, meaning we were just really concerned that analysts were not seeing the risks in earnings. And now you're getting earnings warnings from the likes of Apple and FedEx and other places. And of course, analysts are then now just having, dropping their estimates like rocks, right? Well, what have we had? We've had pretty darn high inflation, right? Why are we seeing high inflation? Well, because companies are passing through higher input costs, labor costs, materials costs, and so on and so forth. So revenue, in my view, stands to come in pretty good because we are seeing the pass-through of these higher costs. That means revenue will be higher. The question is, are they passing through enough to maintain their profit margins? How is that going to show up on the earnings statements? And maybe more importantly, what's their outlook going to be going forward? And the CEO survey came out today was pretty darn pessimistic. Came out, I think, yesterday, actually. pretty darn pessimistic. Now, I saw somebody chart this. When you get to these levels of pessimism, this feeds that darkest before the dawn, that over and over again, that corresponds with the bottom of the stock market. So it applies even to that CEO sentiment. We don't know how this is going to play out, folks. What we have right now that we haven't had in 40 years is inflation, that's really, really high, and a Federal Reserve that doesn't seem to be inclined to help out or help the folks who are feeling so dark start to feel brighter or feel better about their conditions. So this notion that something has to break, my view is something has to crack for the Fed to begin to back away from their tightening. Right now, I believe what's factored into the mix, or to what market's expectations are, is a 0.75% hike at the November meeting, 50 basis points after that, 25 after that, and then halting. Nick told me this morning, I haven't looked at it yet, but on the Fed funds futures, that we're back to looking at March as a Fed pivot to actually begin decreasing, where the market was discounting May previously. Fed governors are pretty much saying they don't think they'll be cutting rates next year. So the market thinks differently. All of this I'm going to look at here after I'm done shooting this video, because I've got to get to work on our macro analysis for the week. And we'll look at things like swap spreads, the CPI swap spread, and so forth. And from what I understand, those expectations are actually coming down quite rapidly. And in the University of Michigan's survey, which I'll also be looking at today as well, expectations for inflation on a 5-year basis are beginning to come off the boil as well. And the Fed keeps talking about how important inflation expectations are, and that they have to get those ratcheted down. The data, however, today was pretty darn good. The data yesterday was pretty darn good. That should show up in my macro analysis in the video that I'm going to be shooting here later today, ideally. So we'll see if our index doesn't actually improve a point or three as well. And again, that's good news, and it's probably good news for earnings, meaning the market may do okay during earnings season. It may be a little better than what analysts are ratcheting down to, but that doesn't help it from the Fed's narrative perspective. The better the economy does, the more emboldened they're going to feel about tightening monetary conditions. Okay, so let me stop rambling there and just share with you some highlights from the firm whose data we subscribe to give us insight into what's going on under the surface with options dealers and the hedging that they have to do and so on. So I think I mentioned once or twice here recently that JP Morgan has an ETF now that employs an options collar on the S&P 500 that rolls every quarter. Today was the roll date. So I'll jump to their narrative on that. And here I'll paraphrase. A quick interlude on today's JP Morgan roll, which we think garners probably too much attention now. There will be several large S&P 500 block trades today as dealers facilitate this collar roll. Ultimately, today's JPM collar will expire, and a new one will be established for December 30th options expiration. The market impact of this today could come from intraday hedging of this position, which has a minimum level of more or less $10 billion, maximum level. This has the potential to impact volatility today, but it's tough to estimate where and when. Odds are there will be some large prints, some potential jumpiness into the close. What's interesting about today is it's not that large, but it's meaningful because it's purely put positions. And it's enough to give equities a bump that could lead to a rapid decline in implied volatility. So let me tell you what happened earlier today. We came into the session red, then kaboom, we screamed higher. Market was up over 1%, S&P, NASDAQ was up well over 1%, and absolutely, like that sentence just said, implied volatility fell like a rock. That VIX, which measures implied volatility on S&P options, was down over like 7.5%, almost 8%, after being slightly up early in the session. So that is a big plummet in implied volatility, which implies and suggests to me that a lot of that activity did have to do with this JP Morgan collar. So my point is, folks, that today clearly or likely today's volatility had something to do with this collar position that got rolled into the future and all the dynamics around when that actually happens. Now, these guys also happen to be pretty bullish going into October, perhaps all the way to the October expiration. They also talk about the serious macro risks that are out there, so be careful with that. And that's been my messaging here as well. So, folks, in a nutshell, this latter part kind of explains this crazy day today, at least to some extent. And remember that we have substantial net short positions in the futures pits on many of the averages. As of last week, there was still net long the NASDAQ, but we'll see if we still are. I'll find that out later today as well. But there is plenty of oomph for a nice bear market rally here. The Fed is definitely a big headwind to that. Seasonality would be the tailwind. The technicals short term would be the tailwind. And we probably not that far away. We may be lower than our 3,500 target. We'll find that out soon probably. But we may not be all that far away from building a durable or a sustainable bottom here in this market, believe it or not. I think it's safe to say that we're closer to the bottom than we are the top right here. So folks, I will leave it there. One more session coming from me, either today or early in the weekend. And hope you have a good one. Thank you as always for watching and listening. Talk to you again shortly. Take care.